What's up, everybody? We're going to get into the 2023 market outlook, economics, the stocks, all that kind of stuff right here, right now. And wow, what a 2022 we had. Everybody like to take a sledgehammer to that and get rid of it, right? We're theming this a balanced act here going forward for 2023, because if you look at this, you've got some smaller rocks on top that are kind of teetering. There are some things, if it goes a different direction, maybe we go back down in the marketplace. But then we've got some pretty big rocks here on the bottom, some good stabilizing factors. I'm going to go through some great charts. You got to stick around that kind of lead us into a positive kind of 60% probability of the market finishing higher this year. So I'm going to show you what that whole outlook looks like. So let's get into this. I'm going to zoom into this thing so you can see it a little bit better on here. So obviously this year we finished at almost 20% down on the market. We did get into a bear market where the market drops more than 20%. So as you can see from this chart here, we hit the bear market really in June of this past year, and it's been obviously 12 months since the peak in January. So now we see the average type of bear market. If you look at all these past big drops of the bear market, averaging about 11 months. So we're there. So do we go forward on the upside or do we go back down? We're going to see what happens here coming up. But what's really interesting is most Wall Street strategists, if you look on this chart here, goes back a decade. Every single year they've been predicting a positive year. Now some lower than others, right, coming in here. But last year they predicted positive. The majority of Wall Street analysts. Didn't happen, way off. And I'm even going to show you here in a second what our wonderful Federal Reserve was predicting. And these are the guys making the policies of what's going to happen with interest rates affecting mortgage loans, car loans, credit card loans, what you're earning right now at the bank, all that. And this year, the Wall Street strategists are predicting a negative year. And you can see not a huge negative year, but a negative year on the stock market. So this was interesting right here. If you pull this up and look at this, and this is by Ryan Dietrich. He's with Carson Group. Follow this guy a lot. He's got tremendous charts he puts out. Love him. And we'll be covering several of those charts in this thing today. But in June of 2021, if you see right up here on top, the Fed expected rates right on here to be near zero at the end of 2022. Do you know where they are right now on the federal funds rate? We're at 4.5% and probably going higher over the first part of this year. January 28, 29 is when the Fed meets again on that. So it basically went on one of the most aggressive rate hikes campaigns ever. In fact, here's where the Fed doesn't even know what's going to happen. Right after they make a statement, Powell, if you look on here, he said a 75 basis point rate hike is not being actively considered. This was printed May 4th. I know you can't really see that, but I blow it up more. May 4th, 2022. And you know what they did after that? Not one, not two, not three, but 4 75 basis point rate hikes. So that just shows you all these guys that go to these, get all these big degrees and everything, analysts, they're economists, they can't even predict what's going to happen. So what does that mean with you and I as individuals here trying to do that? This was just the actual Fed funds rate prediction that they put in their economic projections, the Federal Reserve Board members and their actual books and everything. So that's in there just to show the proof. And another thing that comes up, which I find very interesting, is this is Standard & Poor's. So if you go to S&P Global.com up here on the top, I know it's kind of hard to see that too, but S&P Global.com, they've got this report called the SPIVA report, SPIVA. And it's what it is, it tracks indexing. So just buy an index versus active managers. So IVA, indexing versus active managers. And if you look historically at this, I pull this up here. This goes back 5 years, and it looks at the percentage of actual active managers, money managers that have underperformed the index. 84% of the time, active managers underperform the index. That means only roughly 15% of those managers have outperformed just owning the S&P 500. And if you go to 10 years, that number jumps to 90% underperformance. And then you go out 15 years, we're about the same, so 90%. So this is a key theme that we use with our client portfolios as well. It is very hard to beat the market, as definitely well recognized here. When you see that information from the Fed and Wall Street strategists making their predictions and not being able to achieve a lot of success historically, that drives a certain type of financial planning strategy that we utilize for our clients. If you want to know more about it, give us a call and we can show you what that is. So, all right, let's look at these base case scenarios that we've got here for forecasting for 2023. We've got a bear case, we've got a base case, which is what I was alluding to before at the beginning of the video, and then we got a bull case over there. So the base case is that we do is a 60% probability that we're seeing here. And with that, we see on the economy-wise, probably flattish growth and possible recession, but just a very mild recession. We have that. And I'm going to talk more about recessions. This is a huge point. It brings this big thing about recessions. It's horrible. I'm going to show you some numbers that might make you think when they mention the word recession again, it's not necessarily always a really big deal. So let's talk about that. Inflation remains stubbornly, that's in the bear case, remains stubbornly high, gradually easing, which we're seeing. I'm going to show you some charts that support that. And then we've got interest rates move gradually lower. We're starting to see that on the 10-year Treasury, the Fed, or the 10-year Treasuries. Not necessarily the Fed funds rate, the federal funds rate that the Fed has been moving up to now 4.5%. That usually comes later once they see things slowing down. And then maybe they need to reverse course because they've gone too far. But on other interest rates that are anticipating possible economic slowdown, we see interest rates gradually easing. Interest rates, we just talked about that. Inflation, we talked about that. Let's move this up. And then we see the Fed actually pausing in our base case early spring of 2020, which is what we're kind of seeing here, right? Kind of anticipating some lower Fed movements of interest rates here over the next couple months, and then pausing at that point. Earnings stall and growth wall, cost pressures still in place. Geopolitics, progress comes slowly in China and Ukraine. Valuations are modest on the company's earnings. But we do see, bottom line is, on our base case, about 4,400 to 4,500 on the S&P 500. That would put us right around a 10% growth rate from right here. In our bear case, if these things don't really play out and we get these things here where interest rates are staying higher, go further higher, go higher, inflation remains stubbornly high, earnings drives double digits decline, and then the Russia-Ukraine situation comes to more of a head and there's more issues with that, then maybe we do get a base case and we drop 10%. 10 to 15%. We're looking at about a 3680 on the S&P right here on that. But then if a lot of this comes out even better, we see a bull case of maybe that's almost a 20% jump in the marketplace, which would kind of support some of the charts coming up that I'm going to show you. So that's our base case there. So with the Federal Reserve, and this is kind of supportive of the Federal Reserve situation I'm talking about, that we're getting close to an end of the Fed funds rate being moved up, is that typically the federal funds rate is moved up to match inflation. We were at a point where inflation over here, I know it's maybe harder to see, but it was at 8.3%, and the Fed funds rate was only at 2.5. Well, now we're 4.5, and the inflation rate's around 6.9. I think the last time I reported 6.98, so that equilibrium is coming, where we might see that because if things continue to drop. This is just more of the inflation numbers are showing to come down on here. So I blow this up some more. You can see this. It peaked up here and it's starting to come back down. So we see that. Another evidence of that is rents. So this is a big deal. The housing market took off with interest rates so low, right? So we had people buying and buying, getting those low interest rates, driving up prices. But it also drove up rents because a lot of people couldn't afford the prices. So it was moving these rents up, but now they're starting to come back down here. The last 2 months, we've seen rents prices come back. Let's see here. I'll get back into this. U.S. car prices continue to drop. So used car prices are dropping back down. That was a big theme during COVID. People couldn't find cars, inventory, because people couldn't, or companies couldn't build the cars, right? They couldn't get the parts, couldn't get the computer chips, all that stuff from China and everything. But now we're starting to see used car prices drop back down. And then jobs. We've never seen, I wouldn't say never, let's just say this many jobs that we've created, which recently it's like 4.6, 4.3 million down here on the bottom. Normally does not result in a recession type situation. There's actually a shortage of jobs, or there's a lot of openings and people aren't filling them. So that's an issue. Like if you go to restaurants, you make phone calls to people, it's a lot of delays and stuff like that. And this is the same thing. Not enough workers to fill job openings out there right now. All right, so now I'm going to show you some supportive charts that kind of align with that base case that I'm talking about, as well as looking at the bull case possibly, and looking at these market charts, because this first one, it puts everything in perspective, I think. What this first chart shows is the intra-year corrections that we've seen since 1980. All these yellow lines, every single year in here, there's been some type of correction. With the smallest I've seen is in 1995, and then also in 2017, only about a 3% pullback correction in the market. But normally on average, all these, when you look at them combined, 14% correction every year. So when you're seeing the market go up, usually there's going to be a pretty decent down period during the year as well. It may not happen in the front of the year, it could happen in the middle of the year, but there's usually some type of correction that pulls back. But we still end up historically averaging about 9% a year throughout all these. And the interesting thing is that 9% is very rare to happen. I think since 1950, it's only happened between 8 and 10% return on the market, maybe like 3 or 4 times. It's crazy. And this chart was put out by First Trust. Got to give them kudos on this. And a couple of the other previous charts, also by Carson Group and also LPL Financial. This one's by Carson Group as well. This leads to the potential of that base case to bull case. Bad 2022, a hope for 2023 after negative midterm years since 1950. These are the drops that we've had. And then the following year, the average is up about 24%. All right, so midterm, that second year of the midterm, and then all of a sudden, boom. And if that leads right here, because since 1950, we've never had a negative midterm year. Actually, the following year has never been negative. Always gained after midterms. So the election that we just had, average is 14% upside. Crazy. Next one. All right, so this one's also interesting. Ryan Dietrich put this out from Carson Group. Says, I've done this for more than 2 decades. Rarely have I ever seen anyone agree on something like everyone expects the first half of 2023 to be bad for stocks. However, I haven't heard many point out that the first quarter in a pre-election year was lower only once since 1915. So 17 out of 18 years, it's been up in the first quarter. All right. And that's what these next quarters coming up, year 2, Q4 that we just had, year 3, Q1, and year 3, Q2 are the 3 best quarters historically when you track the market since 1950. So that would support some potential upside as well. And this is the same chart, just showing it in a different fashion right there. And then it is very rare that we get back-to-back down years. So since 1950, we've only had 2 scenarios where that happened. You had it in 1973-74. You had it during the crisis of the tech crisis in September 11th. 2000 to 2002, and then we just had our negative year. Even in 2008 up here, we did not have two back-to-back years of negative returns in the market. So we'll see what happens here. Usually the congressional makeup. So we've had the midterm elections. Right now we have a Democrat president and we have a Republican Congress, or actually, excuse me, a split Congress. So that is actually the second best type of makeup and presidential makeup that historically does well with the market, averaging somewhere close to 14-15% when you have a split like that with a Democratic leading president. So that's another one. The next one in here is under new U.S. president, stocks underperform early and improve later. So usually year 3 is really good for that new president. And then we had the midterm year pullback of 17% on average. It's pretty, as you can see, common when I showed you the other chart, but the next year is always typically up pretty dramatically on average, like 32% when you get that. And I showed that before. Here's typically a contrarian indicator. So the Bank of America Global Fund Managers survey optimism on global growth is at an all-time low. Worse than the tech bubble, worse than the financial crisis, worse than the 100-year pandemic. So we're talking about right over here, we are at a low point of optimism on global growth on this when they surveyed all. That's usually a good contrarian indicator. Not a guarantee, but. And then net percentage of asset allocators say they are overweight equities versus bonds. The last 2 times this happened was March 08-09 area, and then during COVID, and right now they're underweight equities. And that's usually a contrarian indicator. So the key thing to point out here is that short term, like Warren Buffett says, he can't tell you what's going to happen to the stock market over the next 12 months. But there's a lot of, we talk about that balancing act, some big stones that have been showing you kind of pointing towards that. But to invest in the stock market over 1 year, 74% of the time it's positive. 3 years, 84%, 5 years, 83%. You get to 10 years and plus, it's over 90%, and then 100% at that 15-year cycle. And that's when you talk to our clients and we build out portfolios and financial plans, we base it around that kind of scenario where we're putting money in usually 4 to 5 different buckets of money, factoring in our bucket 3 and 4 money, that growth money, we put that money towards that. Other positive things, consumers, and I pointed this out in my last video, is that consumers have deleveraged since the financial crisis. We're at one of our lowest points ever. There's definitely been some tick up in credit cards and stuff like that lately, but still very delevered situation. And that also is pointing to cash that's out there in portfolios. So we are at a peak where we were in October of 2001, right after September 11th. We're at that point in cash. So the market took off eventually after that. We had 2002 was still down, but then we saw a run up in the market. And same situations here, 08-09, December 08. March 09 was kind of the bottom, and then it took off. So there's definitely some things there that we're looking at. This is just a Fed from the economic research data, just showing that high, about $4 trillion in cash that's sitting out there. I know you can't see over here, but $4 trillion in cash supporting that. All right, now we get into leading economic indicators indicating possible recession. So this goes all the way back to 1958 on here. And if you look across here, indicating recession as these indicators drop. So you can see here dropping and then boom, considered recession. Dropping over here, considered recession. And then now we're seeing this drop again down here in that far. This is what I was talking about before. Recession, guys, let's talk about this. So we actually had 2 negative growth E's in last year, but they didn't qualify as a recession because there's a lot more variables they look at besides just gross domestic product. That's all the goods and services produced in the United States. And matter of fact, there are a total of, and I got this from the National Bureau of Economic Research. These are the guys that actually eventually make the call whether we are in a recession or not, or we went into a recession. There's 8 people that decide our fate on this right here. And you can take a look at them, where they go to school or went to school and all that. A lot of great institutions. But the thing is, usually when they come out and tell us in a recession, markets typically bottomed, as we've seen in other charts, and moving back up. Not always that, but pretty common in there. But just wanted to let you know, these are the guys that actually did it. And they actually, if you're interested in this, they hold their committee meetings in Cambridge, Massachusetts on the 3rd floor. And a gentleman by the name of Bob Hall is the chairman of this. And they don't announce their meetings. It's interesting. Do not announce their meetings. And these are all the things that they look at when it comes to indicating whether they're in a recession or not. So it's got personal income, less transfers, non-farm payroll, real personal consumption expenditures, wholesale retail sales adjusted for price changes, employment measured by household survey and industrial production. This is interesting. There is no fixed rule about what measures contribute information to the process or how they are weighted in our decisions. I don't know. Then how do you make the decision on that? That's very interesting to me. So now here's what my point was, is they talk about the economy dropping. So economy stalls, we lose jobs, that type of thing. We are sitting at a 100 trillion world economy. That's production of goods and services out there. China and U.S. lead the way. So they're predicting somewhere, and we haven't seen these final numbers yet, but somewhere in the 22 to 25 trillion dollars of goods and services produced. During COVID, we still hit 20 trillion, roughly in there. 20 years ago, we were at about 7 trillion. So do you really think if we drop maybe 5 or 10% of goods and services being produced in the United States, even in the world, is that really going to impact us long term? Like if there are going to be new ideas, new inventions, and people are going to continue to buy food and clothing, all your necessities, all that, TVs, eventually the population continues to grow. You got to feed people. Is that really going to make that big a deal? I personally, this is my personal opinion, is yes, unfortunately, there's some people going to be losing some jobs, but can they find new jobs? Can they reinvent themselves? I believe they can. Will human beings innovate? Are they able to adapt to crisis situations? That's why we're still, in my opinion, why we're still here today. And we look at how here 5, 10, 15 years from now, I believe we'll be in a better situation. These numbers will be higher. This is fun to see. We talk about $1 trillion. And come back up. All right, there it is. This is $100 bills, 1 trillion of them worth, put in front of the White House next to a big jet up here. A big old semi truck full of them. Multiply that times 20. Multiply that times 100 to get the world economy. That's a lot of production out there. We've already gone over these. This is what I was talking about before, innovation. So you got on here the companies with the most patents granted in 2021. There's a lot of people coming up with ideas, and there's even people not on this board are coming up with ideas. What if one of those hits? Matter of fact, there's a lot of scientists that just hit one big one coming up here. We had nuclear fusion breakthrough. This could be the game changer from energy going forward and how it impacts everybody's life. Cost structure, dispersion of energy across the world, cheap, clean energy. They harness this. They've actually done it. Now it's just a matter of deploying it. How are you going to do that? This could be the game changer, the revolution that we're talking about right here. You might see the market dropping right now. You might have a lot of concerns. What's going on with the economy, politics, all that. But that could be a game changer right there, along with what these game changers were back in 2003, 2007. You got Google. 2007 was the iPhone. 2008 or 2010 is the iPad, which I'm using right here. Can you imagine if we didn't have all this stuff during COVID, where we would have been? Technology literally saved this economy a lot because of what people were inventing. So basically getting to the end of this and some key stuff. We don't believe in market timing for probably 95, 99% of the portfolios that we manage. We might try a little bit here and there because it's very hard to do. And this just shows you this chart right here. If you were fully invested since 1990, you average 9.9% in the market, S&P 500. You missed the best day of these periods. During the years, 6.1%. Then you drop down to 3% if you missed the best 2 days. You missed the best 5 days, you had a negative return in your portfolios if you're jumping in and out of the market and miss those 5 best days in the market. That's pretty astounding. So that's why we don't try to market time. We try to build portfolios. This is kind of an analogy here where we still want to give you the great view, if you will, for retirement, hopefully, striving to do that. And if a big hurricane comes and tries to wipe you out, we try to minimize the damage by raising you above that damage if you will, strive to do that with some different types of hedging that we do. So if you're interested in finding out more how we do that, give us a call. Be glad to show you, because the last thing we want to do is we don't want your cortisol levels getting really high, because that's not good for your health. Then you can't enjoy your money, because what we are striving not to do is see your money drop 20, 30, 40, 50%. Because if all of a sudden you're down 50, guess what? How much you got to make? 100% just to get back to even. We're striving to avoid that, especially in retirement. That's why I talked about these buckets. We set up these different buckets of money depending on when you need it. And then the farther out, we use that more growth oriented and showed you that chart of probability of investing for growth long term. Not a guarantee going in the future, but just showing you historically. All right, if you want to contact us, give us a call, 513-641-6307. Text us at 513-657-0989. You can email us at william.wilkins@opl.com. And easy way, pursuefinancialfreedom.com. Go there. That's pursuefinancialfreedom.com. There is a tab at the top for a complimentary financial plan. You click on that, put in your data. We'll get back to you and try to set up a time so we can go over some planning ideas with you. And with that being said, I'm going to run my disclaimers on here. We greatly appreciate you joining on. Until the next time, have a great rest of your day. Appreciate it.